Mark Andreessen is a pioneer of a software category that is in use by more than 1 billion people. What is that category? Browser. How many of you started with the Netscape browser? Learned to love it? Arr! And those of you who didn't, it was a beautiful, beautiful thing that Mark created. In addition, he's one of the very rare individuals who've actually created 2 billion-dollar companies in terms of market cap. Now, Sarah Lacy has written a book called Once You're Lucky, Twice You're Good that goes into a little bit of the story of Mark and a few other people who've done this. If you're curious about it, you can read about it there. But another little-known fact is that this is Mark's second visit to ETL. On April 7th of 2000, Mark Andreessen was here. Well, actually, he was in Terman. And he was happy to be reminded of that. He may or may not go into why that is important to him in terms of family matters at home. But Mark, we're thrilled that you're back at Stanford, and let's give him a warm round of applause.
So I just checked online. April 7th, 2000, I was the speaker who was closest to the exact top of the NASDAQ. And so last time you had me, it was perfect timing of a market top. Absolutely perfect. I don't know what that means about what's happening right now. But 10 years from now, we'll look back and we'll say, aha. So anyway, I just wanted to basically, I don't have anything prepared, so I just wanted to basically launch straight into Q&A. Just as sort of background for people who might not have caught up with what I'm doing, my most recent thing is I started a new venture capital firm with several friends and colleagues last summer. Actually, we have 4 of my friends and colleagues from the firm who are here somewhere in the crowd. Over there we go, there's the contingent. And so later on, if you want to talk to any of these folks, Ronnie runs all of our partnership and networking efforts. Fred is our new analyst. This is week number 1 for Fred. And then Dave and Ellen work on our recruiting. We actually run an in-house, essentially recruiting function for our startup companies. And so they work on that. Sorry? Oh, okay, great, got it. Yep. And so we would be delighted, and obviously I'd be delighted to talk to folks afterwards, but we'd be delighted to talk to you. So we started a new venture capital firm last summer. Actually, another story of timing. We raised that venture capital fund starting in March of last year, March of 2009, which was the exact low of the economic crisis, the credit crisis. So there's something in what we do that we hit either the highs or the lows. I don't exactly know what it is. But we raised a $300 million fund last summer, opened up. We've been in business for about 9 months now. We do Silicon Valley tech investing. Our biggest deal so far is Skype, although we've backed a whole series of other interesting companies. And then boards that I'm on at the moment include Facebook, eBay, and Hewlett-Packard. And then I continue to be very involved in my company, Ning, which is a social networking company here locally. And so with just sort of that as a general background, let me just throw it open for questions and see what people want to talk about. Yeah.
Hey, Mark, question for you on moving from being an entrepreneur to venture capital. I'm going to be doing a similar thing. I'm wondering what your perspective is in working with venture capitalists who don't have any entrepreneurial background, which unfortunately represents a large chunk, how you deal with board conflict in advising folks in that scenario.
Okay, so the question is, as an entrepreneur turned venture capitalist myself, how do you work with other venture capitalists who may not have entrepreneurial experience, or in some cases operating experience? Yeah, well, we like to observe that in California you need a license to drive a car or buy a gun, but not to be a venture capitalist. And so it is true that issues arise, and if you talk to a cross-section of entrepreneurs, you'll get various stories in terms of their directors who may not have a deep operational background and some of the issues that arise. So let me just give a few general thoughts without naming names. So first of all, I would say that if you look at the folks who are the best venture capitalists over time, some of them have very deep operating backgrounds and have been entrepreneurs themselves, and actually some of them have not. So some of the very best venture capitalists, as an example, Mike Moritz had a background as a journalist before he became a VC. John Doerr had a background, had worked in engineering and sales at Intel, at Monsanto before that, actually, when Monsanto had a chip business back in the early 80s. And so he had experience in business, but had not himself started a company. Actually, interestingly, Tom Perkins had one of the original co-founders of Kleiner Perkins, but John had not. And then in contrast, of course, Vinod Khosla had been himself a very successful entrepreneur, as another example, and then Don Valentine, another great VC, had been a very experienced operator in the chip business. So you get this very interesting cross-section of sort of success cases. And so one of the things I try to do is not kind of say up front, I don't think there's necessarily a predictor that just because somebody has an operating background or has been an entrepreneur that they're going to be a good VC, or conversely, that if you don't, you're not going to be a good VC. That said, part of the reason we became venture capitalists, my business partner Ben Horowitz and I became venture capitalists after starting and running companies ourselves, was because we think it can be quite helpful and additive to a startup when their investors and board members have actually done it before and have actually been through the experiences. And of course, we go on to say that this is completely irrelevant in the case where your company just instantaneously succeeds and everything is up and to the right and everything is glorious. Then anybody can be a good board member. It's when the times get tough and things get difficult. It helps a lot to have been through a layoff or a restructuring or a forced sale or a recap, all the other things that you restart and all the other things you end up going through as an entrepreneur. And so, I do think that's helpful and important. The characteristic of the venture capital industry right now is that, we're on the sort of fourth or fifth generation of VCs in some of the older firms. And so there are certainly plenty of VCs who have finance backgrounds as contrasted to operating backgrounds or as contrasted to entrepreneurial backgrounds. And so I think there's a real opportunity sort of talking my own book, as I say on Wall Street, I think there's a real opportunity for VCs who have an operating and entrepreneurial background to add a lot of value in these companies. And so we spend time basically, when we go into a situation with the other investors who are already in, trying to understand, do they have that background? If not, how are they, when they get into the thing? So I think it's helpful. The flip side of it, I would say though, the danger, and we got a talking to from all of our friends in venture capital before we became VCs, and they were very rigorous with us on this point, so I think I'll repeat it, is the danger of an operator who becomes a VC is that he continues to want to be an operator, and so then he tries to operate the companies that he's in from the board, and of course that's lethal. Like that's just a prescription for disaster. And so the best professional investors we've found over the years are very good at understanding what's going on, and they're very good at helping, but they have a remove from the day-to-day operations because the minute they don't and the minute they get too hands-on, things start to go seriously wrong. It really is impossible to run these companies from the board. And so we as VCs are going to try to live up to that. Yes, sir?
The app market is somewhat hot. I think it's kind of urgent. They have $100 million fund dedicated to iPhone apps. Do you think the single apps are interesting to invest in, Android apps or iPhone apps, or would you only consider whole platforms on the mobile platforms?
Okay. So the question is on sort of the hotness right now of the application market, especially on platforms like iPhone and Android. And there's a tremendous amount of investment going into companies building applications on these new platforms like iPhone and Android. So we have maybe a little bit of a contrarian point of view on sort of the general sort of assumption behind the question, if you will.
And the reason I'm also asking is an app, it just seems like how much revenue can that actually generate?
Right.
It seems like there's a limit to that.
So the question is, how much revenue can an app actually generate? So our answer on this kind of thing is always, it depends, which is my favorite answer of all time. I can always start an answer that depends and then talk for half an hour. People think I've said something. So it really depends. So it's a little bit like the early days. To us, it looks a little bit like the early days of the PC industry, where in the early days of the PC industry, you would open up a magazine like PC Magazine, and there would be ads for thousands and thousands of different software applications, doing all kinds of different things, games and learning tools and typing instructors and filing your recipes and all this stuff. Most of the companies that produce those applications are long gone because those weren't significant categories. You couldn't build a real business around them. On the other hand, you had companies like Microsoft and Lotus and Adobe and others that were building applications like Photoshop or Lotus 123 or Microsoft Word that turned into empires. So I really think on this kind of thing the answer is it depends. And so in a nutshell, we wouldn't invest in an app company because it's an app company, but we also wouldn't avoid it because it's an app company. We would look very carefully at the specific thing of what it does. And by the way, let me generalize out and say that's the same answer I give to almost any question involving a particular category. So people say, well, location-based services are really hot. What are you doing there? Or people say e-commerce is hot again, like with all these new group buying services. What are you going to invest there? And our answer is we are going to do absolutely nothing in the category. Because the worst thing you can do is go into a category and just try to find something to invest in. Because if the good ones are already taken, then you invest in the bad one, you lose all your money. It's a bad formula. And there are VCs who do that. and we don't recommend it. So on the other hand, if we get the opportunity to invest in a very special company with a special founding team and product idea and market position and strategy, then we'll do that in almost any category. In fact, one of our favorite things to do is actually invest in categories that other people believe to be dead. And so, for example, we're very excited about investing in enterprise software. And people say, well, that's ridiculous. Enterprise software is dead. You know that nobody can do that.